When people compare life insurance, the conversation often gets stuck on one question: which policy is best? A better question is, which policy fits the job you need it to do? Today, we're comparing three common options: term life, whole life, and indexed universal life, often called IUL. Each can make sense in the right situation. Each has trade-offs, and none is automatically right for everyone. Let's start with term life insurance. Think of term life as coverage for a specific season of life. You choose a time period, such as 10, 20, or 30 years. If the insured person passes away during that term, the policy pays a death benefit to the beneficiaries. Term life often fits people who need a larger amount of protection for a limited time, like a young family, a couple with a mortgage, a business owner covering a loan period, or anyone whose income supports dependents. The main advantage is simplicity. Term is usually the most affordable way to buy a higher death benefit during key responsibility years. The drawback is that it is temporary. If the term ends and you still need coverage, renewing or replacing it may cost more, especially if health has changed. So, who does term life fit best? People who want strong protection at a manageable cost and whose biggest risks are tied to a specific time window. Now, let's look at whole life insurance. Whole life is designed to provide lifetime coverage as long as required premiums are paid. It also builds cash value over time. That cash value can be accessed through policy loans or withdrawals, depending on the policy terms, although doing so can reduce the death benefit and may have tax consequences. Whole life often fits people who want permanence, predictability, and guarantees built into the policy. It may appeal to someone planning for long-term family protection, estate considerations, legacy goals, or final expenses. The main advantage is certainty: lifetime coverage, fixed premiums in many designs, and guaranteed cash value growth according to the contract. The drawback is cost. Whole life premiums are typically higher than term for the same initial death benefit, so it may not fit someone seeking maximum coverage at the lowest current cost. So, who does whole life fit best? People who value long-term guarantees, steady structure, and coverage intended to last a lifetime. Now let's talk about indexed universal life, or IUL. IUL is a type of permanent life insurance. It can provide lifetime coverage if properly funded and managed. It also has cash value potential, with interest credited based partly on the performance of a market index subject to caps, floors, fees, and other policy rules. Important: IUL is not the same as directly investing in the stock market. You are not buying the index. The policy uses an index crediting formula, and results can vary. IUL often fits people who want permanent coverage, flexibility, and the possibility of higher cash value growth than traditional fixed policies may offer, while still having some downside protection through policy features. The advantage is flexibility. Premiums and death benefits may be adjustable within policy limits, and cash value has growth potential. The drawback is complexity. Costs, caps, participation rates, loan provisions, and policy performance can all affect the outcome. If underfunded or misunderstood, it may not perform as expected. So, who does IUL fit best? People who want permanent coverage with flexibility and are comfortable reviewing the policy over time with a qualified professional. Here's the simple comparison. Term life is often about protection for a temporary need. Whole life is often about permanent coverage with guarantees and predictability. IUL is often about permanent coverage with flexibility and index-linked cash value potential.